what we are seeing right now is this systematic bleed down of inventory across the globe by the most well-informed and well-funded traders on the planet. And that betrays the poor performance. I mean, people should think, in the environment that we find ourselves in, 40-year high inflation recently, geopolitical and political upheaval, the BRICS, all of these things, we would expect gold to be much higher. And it will be, but it is the suppression of the paper market that the West is clinging to make their system and the bond market and the system seem stronger than it really is. And the East and their foes are sitting there saying, great, suppress the price. We'll stand for delivery. We don't care.
Andy Schectman, the CEO of Miles Franklin, has raised concerns about the current global economic environment marked by high inflation, geopolitical instability, and political turmoil. In such circumstances, one might expect the price of gold to soar as it typically serves as a safe haven asset. However, Schectman suggests that the price of gold is being artificially suppressed due to manipulation in the paper gold market in the Western world. Price manipulation is a phenomenon that exists in financial markets where traders attempt to influence the prices of assets, in this case, gold. Paul Craig Roberts and Dave Kranzle from the Institute for Political Economy claimed that the New York Comex exchange is the primary venue for the Federal Reserve's manipulation activities. Notably, some of the largest players in the Comex market, including HSBC, JP Morgan, and Bank Nova Scotia, jointly account for a significant portion of the exchange's trading volume. In addition to Comex, the Federal Reserve is alleged to manipulate gold prices in the much larger London gold market, where daily transactions exceed $24 billion. In addition to these factors, data from the World Gold Council indicates that global central banks have been increasing their gold reserves. They reported healthy net purchases of 55 tons in July, signaling a longer-term trend of central banks accumulating gold. Schectman suggests that central banks, which are generally well-funded and knowledgeable, seem to be accumulating gold for a reason. Before you watch Andy Schectman's interview, subscribe to our channel and give this video a big thumbs up.
I think we can draw an analogy between a country like China versus one like the United States. We think in terms of minutes and hours and days and weeks, and they think in terms of years and decades and centuries. And, I think from a macro perspective, the case for gold has never been stronger on every single level. When I look at several criteria that makes me say that, you have the Bank of International Settlements reclassifying it as a Tier 1 asset, the only other one next to U.S. dollars and treasuries as far as central banks are concerned. You have a massive drive to repatriate gold by the central banks from the centers of deposit, namely the United States Fed, the New York Fed, or the Bank of England, where metals have been held for quite some time. And we've seen this drive to repatriate for some years now, the Bundesbank starting the push, but the Dutch National Bank and the Czech National Bank and the Bank of Austria, Poland, Hungary, they're all repatriating their gold on top of accumulating gold. And when you talk about the central banks who over the last 15, 18 months have bought more gold than at any time in their history, I look at them not only as the most well-funded banks, of course, or entities rather, of course that's relevant and important, but I also look at them as the most well-informed, and that's more important. They know the playbook. And, it's kind of like NFL football game when it's pouring rain out. They say, actually, passing attack in the pouring rain is better than running because the quarterback and the receiver know where the play is going. The defense has to react on a wet field. Bad analogy, but I hope you get my point, and that is the central banks know where to go on the wet field in front of us, and they know the playbook. And I think when you see the most well-informed, on top of well-funded, sophisticated investors on the planet buying more gold than in any time in history, it betrays the price, it betrays the rhetoric, but flipping that around, that's exactly what they're using. The price that is so counterintuitive, the rhetoric that is so anti-gold by the establishment to run cover for their acquisition, their methodical acquisition that is showing itself in the bleeding down of inventory from not only places like the Comex and the LBMA, but also the Shanghai Gold Exchange, the Shanghai Futures Exchange, and backdooring it out of the ETFs in a way that is very opaque. I think that from a 30,000 foot perspective, Jesse, I'm incredibly bullish on gold and silver. But by the same token, I understand the frustration that people watching this video may have and saying, well, why the hell isn't it going up the way it should? You may not see things as clearly as you would expect to. And I think that's where we are right now in the gold market, that most people don't see things as clearly as perhaps the central banks and the commercial banks do, who are accumulating copious amounts on every bit of weakness they see. So I think you got to hang on tight. I think we're just beginning on what will be um, a much, much, much higher price in both gold and silver before the music stops.
Andy Schectman highlights an important relationship between the price of gold and real interest rates. When the economy stabilizes and interest rates rise, it can potentially be unfavorable for gold prices. In the 1970s, gold prices rose significantly despite rising interest rates. This was due to inflationary pressures and global economic instability, which drove investors to seek the safety of gold as a hedge against economic uncertainties. In the 1980s, gold prices fell as interest rates declined. Lower interest rates made other investments, such as bonds and equities, more appealing than non-yielding assets like gold. In 2022, gold prices initially surged in response to the Russia-Ukraine war and the Federal Reserve's rate hiking cycle. However, gold prices later fell as the war dragged on, and the Fed signaled that it would continue to raise rates aggressively. In 2023, gold prices rebounded as inflation moderated and expectations for Fed rate hikes have eased.
There's a term in economics called Gibson's paradox, which speaks to the inverse relationship between the price of gold and real interest rates. Real. And for those that don't understand the difference between real and nominal, nominal interest rates are the price we see quoted, let's say, on the 10-year Treasury. Let's say that's at 4.5%. That's the nominal rate. Subtract inflation away from the nominal rate, and you get the real rate. Now, problem is the CP lie that the Fed gives us is really not right, or the Bureau of Labor Statistics, it's not right. It strips out so many of the things that should be in it. If you believe that inflation is only 3%, I got a bridge to sell you. Look at how expensive things are getting, and that's where John Williams of Shadow Stats comes in and tells us the way that inflation used to be calculated. If they hadn't changed it, it would be 2-3 times what it truly is. But to his point, what he's getting at is true. Do I think the governments will be forced to pivot? Well, that's what the bond traders will tell you. That's why you see an inverted yield curve. The inversion of the yield curve, maybe the most inverted it's ever been, or for the longest period of time. Number one, it always precedes every single inverted yield curve since 1950 has preceded a massive, or at least a recession. This would be a massive one based upon the length and the depth of the inversion. But it also, basically what it's saying is that we'll pay you more money for a 3-month or a 2-year treasury than we will for a 10-year treasury, because they're saying that as we get further down the line that the Fed will have to pivot. They will have to lower rates again because the economy will break. That's the conventional wisdom. A lot of what I've talked about with you and others, it talks about that moment when the world no longer takes dollars for oil. Maybe it's somewhere down the road. All the members of OPEC all of them on the Belt Road Initiative, and now safety in numbers in this ever-growing group of countries that present a very formidable foe, in particular militarily, say we're not taking dollars for oil anymore. And why? Because you guys signed an executive order, you idiots. You signed an executive order right when the current administration came into office saying we're going green by 2030, 80% by 2050, 50 by 2030. So with respect, we are now going to associate with the countries that represent close to 90% of the world that aren't going green. And that's why we've joined these countries. So here's the thing. If the country was stable and everything got back to normal again, and you saw interest rates where they are right now or escalating even higher, yeah, gold's in trouble because you can earn, in a 3 month treasury right now, 5.5%. By the way, when you talk about how fast it's gone up, the beginning of 2022, that 3 month treasury was 0.06%. Now it's about 5.5. The speed at which they raised interest rates is nefarious, and you wonder if there's something more behind it. I do, and we can talk about that as we go along, but still hasn't gone up high enough to make the return on these investments anything other than zero, maybe very slightly positive using their BS inflation numbers. The real inflation numbers were still negative. But here's the point. The question becomes, how bad does it get? In a rising real interest rate environment, gold would do poorly. But think of what happens if rates go high enough. What happens to the economy? Stocks, bonds, and real estate collapse. And all of these asset prices have been blown sky high due to years of suppressed interest rates and 4 years worth of money creation that was greater than the history of the United States preceding it. And so those asset prices, which have been distorted massively, real estate, stocks, and bonds, in a rising interest rate environment, cross the line of it being a religious experience.
Furthermore, Schectman mentions Basel III, which has introduced changes in the regulatory framework for banks. Under Basel III, Tier 3 capital has been eliminated, and new liquidity ratios, such as the net stable funding ratio, have been imposed on banks. Notably, gold held on a bank's balance sheet is subject to an RSF factor of 85%, and the Bank for International Settlements has classified gold as a top-tier asset alongside US dollars and treasuries. How might the global gold market dynamics impact the future trajectory of gold prices and the role of gold as a hedge in uncertain times? If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Surprisingly, around 77% of our viewers have yet to subscribe. We're aiming to reach 3,000 subscribers as soon as possible, and your support could make a big difference. Thank you for being a part of our community.